Hello and welcome to Earnings Echo. We put together the most important information about Shopify. I mean, imagine processing a staggering $101 billion in gross merchandise volume in a single quarter.
Right, basically moving the GDP of a small country right through your checkout screens.
Exactly. And Wall Street just, well, they yawned. So today we are doing a deep dive into Shopify's Q1 2026 earnings to figure out why a massive double beat wasn't enough.
Yeah, and we'll break down what their hidden structural drivers actually mean for your portfolio.
Let's start right at the top line. Just hit me with the hard facts. Where did revenue and EPS actually land?
So revenue came in at $3.17 billion. That is a 34% year-over-year jump, which, beats consensus by about 2.5%.
Okay, and on the profitability side?
Earnings per share landed at 33 cents, so they beat estimates by 3 cents.
Which is a really solid double beat, yet the stock barely flinched after the release. What is the disconnect there?
Well, it really comes down to the forward guidance. Management projected high 20% revenue growth for Q2.
Which technically matches the 26.5% analyst consensus, right?
On paper, yeah. But you have to look at the trend over the last 12 months. Those consensus expectations had quietly surged by 15%. So the market essentially moved the goalposts while the ball was in the air.
Oh, I see. So meeting expectations just isn't enough when they're already priced for an absolute blowout.
Exactly.
So to understand where this underlying growth is actually coming from, we have to look under the hood. The real standout here is Merchant Solutions, up 39%.
Yeah, and that is heavily fueled by Shopify payments. They have reached a 67% penetration rate there.
So instead of just charging, a flat software rental fee, they're taking a tiny slice of every single transaction that flows through.
Right. And with 2/3 of their merchants now using that native processor, it creates this massive compounding effect as overall sales volume grows.
What about subscription solutions, though? That only grew 21%.
True, but that figure is a bit deceptive. They are finally lapping a deliberate headwind. Last year, remember, they lengthened their free trial periods.
Oh, right, which delayed revenue recognition.
Exactly. With that in the rearview mirror now, subscription growth is just normalizing.
Okay, but let's talk about the cost of all this growth. Their GAAP gross margin dropped to 48.8%. It seems like this massive success in payments is actually a double-edged sword.
It is, yeah. Merchant solutions inherently carry lower margins than pure software. And on top of that, they are burning cash on large language models to power their new AI tools.
So margin compression is real here. Is it eroding the bottom line?
Not really, mostly because of their sheer operational scale. Even with those AI computing costs and the mix shift toward payments, free cash flow stood really strong at $476 million.
Wow, that's a 15% margin. That is highly durable.
Yeah, they're keeping operating expenses incredibly flat despite that massive top-line surge.
Which actually brings us to the tone of the earnings call. You would think managing those rising computing costs would have management sweating a bit.
But they sounded almost euphoric. They literally called AI their native language.
And an exoskeleton for the workforce, right?
Yes, like they have built a robotic suit for their developers and support teams. It lets them do the heavy lifting of a much larger company without actually having to hire more people.
And that exoskeleton is exactly what's keeping those operating expenses contained. It also seems to be giving them the leverage to move significantly upmarket.
Definitely. In Q1 alone, they landed massive enterprise clients like Luxury Titans, LVMH, and Mulberry.
Huge names. And looking to Q2, management expects gross profit to grow in the mid-20s, keeping operating expenses tightly capped around 35 to 36% of revenue.
Right, and sustaining those mid-teens free cash flow margins we talked about.
So distilling this down for your portfolio today, the ultimate echo is that Shopify has built a compounding platform advantage. They are leveraging deep AI integration to capture massive enterprise clients.
All while keeping their headcount completely decoupled from their revenue growth.
Exactly. They have transitioned from a simple website builder into a highly efficient self-scaling commerce engine.
I completely agree.
Which leaves you with one final thought. If AI is just an exoskeleton today, helping humans work faster, what does this commerce machine look like 5 years from now when that intelligence is completely autonomous, managing inventory before a merchant even asks?
It is a massive structural shift to watch.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.